Growing up in India in the 1980s, I often saw a curious monthly ritual unfold in our neighborhood. On a quiet Sunday afternoon, just as the summer heat began to ease, women from surrounding houses would gather in someone's living room. The air would fill with the clink of bangles, the hiss of chai simmering on stove, and the hum of conversation, half gossip, half laughter. At first glance, it looked like a purely social gathering. But it was something far more powerful. Each woman would bring a small envelope of cash, maybe rupees 100, which was roughly equivalent to about $8 at that time, and place it into a communal pot at the center of the room. Once everyone has contributed, one name would be drawn. That person would take home the entire pot that month. The following month, they would meet again, contribute again, and someone else would get the payout. The cycle continued until everyone had received their turn. There were no contracts, no lawyers, no bank accounts. Just a circle of neighbors bound by trust, discipline, and a shared belief that pooling their small contributions could help each of them accomplish something bigger, pay a child's school fees, buy a gold jewelry, or handle a medical bill. As I grew older, I realized something fascinating. This idea wasn't unique to India. Similar systems exist all over the world. Now, I want to apologize in advance. I might not be pronouncing these things accurately. But in Latin America, they're called tandas. In Caribbean, they're called susus. In Chinese communities, they're known as hui. In Mexico, they call them candianas. Even modern credit unions come from the same basic idea, people pooling their money together. So each person can achieve something they couldn't do alone. Humans have been doing this for centuries. After all, we are social creatures. And pooling resources is one of our oldest financial instincts. And interestingly, this simple neighborhood ritual is also the spiritual ancestor of something far more modern and structured: real estate syndications. Now, of course, when people pool their money for investments in the United States, things need to follow certain rules. Unlike that living room gathering in 1980s, modern investing involves regulations designed to protect investors. Back in 1930s, after the stock market crash and the Great Depression, the US government introduced laws to regulate investments. One important principle emerged from these laws is that if people invest money expecting profits that will be generated primarily by someone else's efforts, then that investment is considered a security. And securities have rules. Real estate syndications fall into that category. Think about it. In a syndication, multiple investors contribute capital. A sponsor or operator finds the property, manages it, improves it, and eventually sells it. Investors benefit from the work done by the sponsor, which means that the investment has to follow securities regulations. Over time, these rules evolved to make syndications easier to structure. In 1980s, regulatory changes allowed sponsors to raise money from investors without having to go through extremely expensive process of registering every single deal with the government. This made it much easier to pool capital for real estate projects. Large apartment buildings, office buildings, and commercial developments suddenly became accessible to groups of investors working together. But for many years, there was still one big restriction: sponsors could not publicly advertise these investment opportunities. Deals had to happen quietly within existing relationships. In other words, if you didn't already know the person organizing the investment, you probably wouldn't even hear about the deal. Now, that changed in a big way just a decade ago. In 2012, a law called Jobs Act allowed sponsors to openly talk about investment opportunities as long as the investors met certain financial qualifications. For the first time, syndications could be discussed online. Platforms began emerging. Sponsors could reach investors far beyond their personal networks, and that opened door to modern era of real estate syndications. Today, syndications have become a well-established way to invest in real estate. Instead of buying an entire apartment building yourself, you can invest alongside others. The sponsor finds the deal, the sponsor manages the property, the sponsor handles the renovations, financing, and operations. Investors contribute their capital and share in the income and the long term appreciation. In many ways, it's still the same fundamental idea that those women in my neighborhood practiced decades ago: pooling resources, working together, helping individuals participate in opportunities that would otherwise be out of reach. The difference is what once happened in a living room over cups of chai now happens through structured legal frameworks, regulated investments, and professionally managed real estate. But the underlying idea, that hasn't changed at all. Sometimes the most sophisticated financial structures are simply modern versions of very old human instincts. Thank you for listening to me. My name is Vaibhav Puranik, and this is the OMC Real Estate Podcast. Our website is oldmoneycapital.com, and our YouTube channel is Old Money Capital. Our Instagram account is Old Money Capital 123. You can schedule a call with us by clicking on the Request a Call button on our website. In the call, you can learn how syndications work and how we can help you with it. Thank you again.